All right. Good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Give us just a second here to go live on all the different platforms. Appreciate everybody tuning in nice and early. We got the chat up there on the screen. Feel free to drop a comment as you tune in here this evening. You can also drop any questions you have in the chat. Jose'd be more than happy to answer any questions anyone has on the presentation here today. So feel free to drop any questions you have in the chat as well. Looks like we're live on all the platforms, so we'll go ahead and get started. Let me go ahead and take the chat off the screen for now, and we will go ahead and get into it. So welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our sales manager, Jose Gonzalez. And we are a lender that specializes in non-QM loans. And what we do every Tuesday and Wednesday and Thursday evening at 7 p.m. Eastern is this loan officer training series where we do an in-depth training on a different loan topic. Tonight is a great one, which is how to structure a BRRRR transaction, which is something that me and Nick are big fans of. And then, of course, a lot of our loan officers and Jose are fans of completing for clients, right? So definitely something cool, definitely a hot topic. So for the loan officers out there, especially those ones dealing with investors or people who want to be investors, just keep in mind this is definitely a hot topic. It's a hot, keyword. It's in all the podcasts. So you need to be familiar with this type of transaction, these type of terms, and be able to help your clients with them and talk to them about it, and even let people know what it means that don't, right? So without further ado, let me go ahead and turn it over to Jose to get into the presentation here. So go ahead, Jose.
Good evening, everyone, or good afternoon for those of our attendees that are on the West Coast. Tonight, definitely a hot topic, right? Tonight's presentation is basically geared not just to our loan officers out there, right? Real important to know how to handle these transactions, but to our investors that are out there so they can know how to structure it and also so they can know who to reach out to help them with their structure in the most efficient manner. If you're a loan officer, like Kyle was mentioning, you definitely need to know how to navigate these waters to help the investors. And definitely, when we're talking about sustainable MLO careers, keep in mind that most BRRRR transactions are two loans in one. If the investor is planning on holding on to the property as an income producing rental, which most of them do nowadays because the rents are just so profitable. So let me go ahead and get right into it because it's all explained here in the presentation. Now, as always, I like to give a little context as to why I feel that this topic is important. So we all know right now the investors are driving the market, right? There's a lot of investors out there buying properties to rehab them and sell them, or rehab them and keep them as an investment properties. We also know that non QM originations have increased as a response to higher interest rates and the need to find alternative options for borrowers to qualify and alternative ways for borrowers to get a home. Now, these fixed flip loans are a great option for borrowers to obtain short term financing because these are bridge loans with no prepayment penalties, allowing them to purchase and rehab the property with the same loan and not use their credit cards for the rehab. That's super important, folks, because once you start jacking up the balances on those credit cards, the credit scores are going to drop. And then you may have an issue on that next loan you're looking to get, whether it's another BRRRR loan or whether it's the end loan to refinance out of the BRRRR loan. We all know that low property inventory for sale has made rehabbing even more profitable. That's why we get all of these deals from these fix and flippers. Rent, rents are rising faster than interest rates, also making the fixed flip loans converted to DSCR loans extremely popular. And as I mentioned, a BRRRR investor will need two transactions if planning on holding the property as a rental property. They're going to use the initial fixed flip loan to purchase and rehab the property, and then they're going to refinance out of that fixed flip loan, usually with a DSCR loan, because the DSCR loan has limited or no seasoning on title required. And to remind those of us out there what I mean by seasoning on title, and I'm not talking about salt and pepper, I'm talking about how long the owner has been on title to the property, because that's what's going to determine usually if we can use the new market value of the property, right? Which is going to be worth a lot more after repairs than it was when it was purchased. Because the other option, if seasoning is an issue, is to use the purchase price plus renovations, and usually the market value will be higher than the purchase price plus renovations if it's a good flip. So, real important to note there. That's why it's this segment of the market is one of the good niches to target, so that you will have a good multiplier there on your transactions of at least two, and then a happy flipper will come back for more, right? So, what exactly does BRRRR stand for? Right? It stands for buy, rehab, rent, right? Refinance to recuperate your investment and additional monies, right? The profit, so that then you can repeat the transaction by buying another property to again rehab it, rent it, refinance, and so on and so on. Now, it's real important for the investor as well as the loan consultant of the investor to remember that we need to plan for the exit strategy. Is it going to be a true flip where you're going to sell the property once the renovations are completed? Or is it going to be a hold where you're going to hold it as a rental property? If it's going to be a hold, remember a rental market study is essential. That's where you should be reaching out to your industry partners, like your realtors. Maybe the realtor that sold you the property can also provide you market rent, so that you can study the feasibility of refinancing out of the BRRRR loan into a DSCR loan. You want to make sure, is your DSCR going to be greater than one, less than one, a lot greater than one, like 1.25 or 1.5, where you're going to get better pricing. Now, all income types are possible, but you see me honing in on the DSCR loans because they're usually the only option that has 0 months seasoning option when you've completed renovations to the property. Meaning you don't have to wait 6 months, you don't have to wait 12 months to get the market value. You can get it now, as long as you can show the renovation that was done. We have options, even light renovation. We have options with zero seasoning required. Now, of course, you can refinance into a full doc, bank statement, P&L, or 1099 option. But again, the DSCR is the preferred one of experienced investors because it uses the property's rental income to qualify the borrower and not the borrower's personal income. And like I mentioned, it's one of the only options out there with 0 months seasoning required on title, meaning you can use market value instead of purchase price plus renovations if you've completed at least some light renovation to the property. So again, important takeaway from this slide: plan for the exit strategy. Now, what is a fixed flip loan? I mentioned briefly touched on it. It is a short term bridge loan designed to help investors purchase and renovate a property, usually to sell it at a profit, but also to facilitate the repairs if the investor decides to keep it and refinance out of the flip loan into a long term loan at the end. The fixed flip loan is not a renovation loan, a rent like a 203K or a Fannie Mae home style, which are not bridge loans. Um, the fixed flip loan, the true fixed flip loan, is only for investment properties. Prepayment penalty is never applicable. That's another reason why the fixed flip loans are the way to go when the rehabber wants to buy the property, renovate it with the funds from the flip loan as well, which is an like frost, that's like the frosting on the cake, right? You're already getting a loan with as little as 10% down to buy the property. Uh, and loan amounts from 50,000 to $5 million. But the key there is never a prepayment penalty and never an early payoff default. Now, what is an early payoff default? That is when the borrower pays the loan off before the early payoff period uh, is expired, and that can be a big issue for mortgage loan originators out there, because if you finance what will be a flip with a regular non-flip loan, and the borrower uses the money to do the repairs and then turns around and sells the property 3 months later, guess what? That's an early payoff default, and the any earnings from that loan are going to have to be returned. That's the early payoff default clawback. So definitely, when structuring loans for a flipper, make sure that you structure it with a fixed flip loan, which does not have a prepayment penalty and is never subject to any early payoff default restrictions. And also, it's the one that's going to let the flipper get in without any consideration of their income, only gauging the loan, qualifying the borrower based on the profit of the flip, the borrower's track record on doing flips, and in most cases, but not all cases, the borrower's credit score. There are a few options out there that do not consider any credit score, only borrower experience and the profit in the flip. So, in order to be able to properly consult the investor, and also in order for the investor to really know what they're doing, there are investor terms that we all need to familiarize ourselves with. And I'm going to run them through here. We're talking about seasoning on title. I already mentioned that's how long the owner has been on title. Now, the best options for our DSCR loan products out there are with 6 months, but 3 and 0 months are possible, as I mentioned, if we show renovation on the property. Another term is recourse loan. A recourse loan is a loan where the borrower personally guarantees the loan. This doesn't mean that it's a loan that does or doesn't appear on the borrower's personal credit. It just means that the borrower guarantees the loan personally and they're responsible for any defaults on the loan personally. Non recourse loan, now conversely, means that the borrower does not personally guarantee the loan. Now, I will state that all of these fixed flip loans are recourse loans, but do not appear on the borrower's personal credit report. So it's half and half of what investors normally want. ARV, real important phrase there, is the after repaired value. In other words, that is the value of the property, the market value of the property after all renovations have been completed. The as is value is the value of the property in its unrepaired state before renovations are completed. The renovation budget is the total cost to renovate the property. Now, the renovation budget is going to be broken down into soft costs, which are the expenses associated with the planning and development of the project, including architectural expenses, engineering tests, and permits. And you have hard costs, which are the actual construction costs, of physical construction costs like materials, labor, and contractor overhead. So, what are some fix flip frequently asked questions, right? These are the ones they're going to ask you. These are the ones you definitely need to know the answer to. And I briefly touched on this first one. Can I finance 100% of the rehab? And the answer is yes, absolutely. We can usually finance 100% of the rehab and up to 90% of the total loan to cost of the project. Now, that 90% is for super experienced investors only, probably done at least 10 flips in the last 3 years or more. And if credit is an issue, they're also going to have, be in that top credit tier. And total loan to cost would mean the purchase price of the asset. So let's say they purchased it for $100,000, regardless of the as is value. Sometimes the as is value is higher than what they paid for it, but the cost would be the cost of the asset and the cost of the renovations. Nothing based on the after repaired value or anything like that. This is loan to cost, and 90% is the max. That would mean that at closing, the borrower would need to give 10% down, right? 10% down payment of the asset, whatever they're paying for it. So they're paying 100 grand at closing. They gotta give 10% down, and the initial distribution would be $90,000 to be able to close, and then the rest of the loan would be the rehab portion of the loan, which is 100% of the rehab, whatever it is, and that's paid out in draws. Right, as work is completed, the contractor puts in a requisition for the draw. It's reviewed and the money is paid out. So it will be paid out in segments. How much experience do I need? Well, zero flip experience is possible for for a borrower with good credit and a profitable flip. Right? If it's a good flip with a high ROI, you're going to be in good shape. Most, I would say, usually the threshold minimum ROI that they're looking for in a flip is 30%. If there isn't at least 30% profit in a flip, that doesn't say they won't do it, but you're not going to get the best terms, even if you've done 20 flips in the last year. If it's not that much of a profitable flip, they're not going to give you the 90% total loan to cost. But again, if you have zero experience, again, and you have a profitable flip, then you're going to get you're going to get in on the action. Another common question is, do I need to make any payments during the rehab? Again, this is going to depend on the profitability of the flip. That's referred to as interest reserve, when you can build in the interest payments into the loan. So if it's a very profitable flip, you may be able to build in a good portion of the interest payment into the loan as interest reserve. How much income will you need to verify? Well, I already mentioned this. No personal income is required. So that means you don't need P&Ls from the borrower. You don't need tax returns. You don't need pay stubs. You don't need anything. But the flip does need to be profitable. That's what it's going to boil down to. That's why you need to know the as is value, purchase price, total renovations, ARV, closing costs. So then you can determine the profit and hope that it's at least a 30% ROI on the deal. Now, here's a very common one, and listen well to the answer, right? Can you pre approve me for a fixed flip loan purchase? Now, the answer is not really, but we can help you size up the deal, right? Or we can help you size up your potential. But remember, each flip is specific, and the profit that we're analyzing comes from the flip. So, unless you have a property already selected for us to review the information where you know the as is value, the purchase price, the ARV, and the renovation amount, and the closing costs, which we can figure the closing cost part out, so that the ROI, the return on investment, the profit on the deal can be figured out. If you don't have the exact property already figured out and have that data for us, all that we can really do is review your credit and review your experience, but the final say will depend on the profit of the flip. So you will need an actual property and the scope of the work, renovation, and the ARV and all the other components that I mentioned, which I'm going to cover in the last slide, so that we can actually quote the deal and then let you know how much will be lent to you, how much will be the loan amount, what percentage, and all that kind of stuff, as well as interest rate. So it's hard to pre-approve anybody for a fixed flip unless you already have an exact property selected. And here's a real popular one. Can I do a refinance of my incomplete fixed flip purchase? And the answer is absolutely. However, it may not be a cashless transaction. Depending on the whole scenario, they may want the borrower to put some skin in on the game if it's an in process flip where basically they're running out of time. Flip's going to come up, the expiration of the loan is going to come up, the current lender doesn't want to extend it, doesn't want to do anything. So it may not be a cash out refinance for the purpose of getting money out. It may just be a cash out refinance for the purpose of getting more money for to be able to finish the flip. So you may not get any money in your pocket cash out. You're just going to pay off the existing lien, cover the closing costs, and then have additional money left over that will be distributed as draws, right? So, but to break it down a little bit more, if it's a cash purchase, that's fine. That's not an incomplete flip per se, but it can be refinanced via a delayed financing option. I already mentioned in process flips can be refinanced. You're just not going to get usually any cash out. You may be able to get additional monies for renovations. Maybe the scope of the work increased. And then, very importantly, at the end, the investor can keep the property and refinance into the end loan, usually a DSCR loan, if that's what they choose to do. And that's what a lot of investors are doing. A lot of the DSCR loans that we pick up as refinances, I would say not a lot, but I would say 30 to 40% of them are flippers that are refinancing out of the flip loan into a DSCR loan because they love the property, they saw the rental comparables, they know it's a moneymaker. They probably would rather keep it for a year at least anyhow to get even more equity and make some of that money back as rental profit, and at the same time refinance and get some cash out to buy another property. So it's a win-win situation if they keep the property, right? Good rental income, they get the money to buy another property, and they hold on to the asset to let it appreciate a little bit more, because usually after a year it's going to be the best option for somebody that's buying the property to get the best loan as well. And lastly, here in this last slide, I'm sharing with our MLOs out there, as well as our investors out there that are looking to get into a fixed flip loan, what is the essential information needed to assess and quote the fixed flip loan. And by quote, I'm talking about the rate, the cost, the loan amount, LTV, all that good stuff, because we're going to run it through a pricer that's going to let us know all of these factors. Now, obviously, the information going in has to be valid because an appraisal will be done. And the appraisals that are done for these fixed flip loan is an appraisal with the ARV value, where the appraiser has to put in the current as is value, the scope of the work, and the after repaired value, which would be the market value of the property in its newly renovated condition. So, information you need here, this is what you need to request from the borrowers and what the borrowers need to be ready to provide to their loan consultant. The name of the LLC or the entity that the property is going to be held in. These fixed flip loans can never be in a personal name, they're always going to be in an entity. Who's the borrower name? Because that's going to be the guarantor. What's the borrower FICO score? Because again, they're going to be the guarantor. Now, real important as far as to be able to get the maximum loan to cost, what is the number of flips for sale in the last 3 years? What is the number of flips for rent during the last 3 years? What is the number of ground up construction deals or ground up construction builds in the last 3 years? What is the name of the general contractor, or if it's going to be a self build? What is the exit strategy? Sell or hold? Real important there. What is the purchase price? What is the as is value? What is the rehab budget, both soft and hard costs? What is the ARV, after repaired value? In other words, the value of the property, the current market value of the property after all renovations are completed. What are the estimated rents? Especially important if you're planning on holding the property after closing, right? We're going to be calculating a debt service coverage ratio. You want to make sure that whatever is your target loan amount, when if you're planning on holding the property and depending on the cash out you want to get, make sure that the debt service coverage ratio covers, or make sure that the rent covers the debt service coverage ratio minimum. And that minimum we're looking for is at least 1.0. We have options where the debt service coverage ratio is less than 1, but usually what's going to happen is the LTV is either going to be lower or much higher rate at a much higher cost. So there are very limited options at a 75% LTV for a low ratio DSCR, where the DSCR is 0.75 to 0.99. And there are no options at a 75% LTV for a no ratio DSCR, where the DSCR is less than 0.75. So again, that's why you really have to do all this planning up front. And what is the property address? What is the term requested? 6 to 24 months are the norm out there. Your best bet is to get at least 12 months. You don't want to have to get a 6 month option. Yeah, the rate's going to be lower, a little bit lower cost, but it's really stressful if you're getting close to that 6 month uh, threshold and you're not ready. And now you got to ask for an extension. They don't want to give it to you. So then you got to refinance the in process flip. And, those aren't the easiest ones to do. And last but not least, what type of draw type are you requesting? Do you want advanced draws or do you want reimbursement after the work is completed? So very important page here. This basically summarizes almost everything that we covered in the other slides, the terms that you have to know, the strategies and all that kind of good stuff. So real important for our MLOs. If you want to be a good loan consultant, please know what you're getting into. You have to be an expert. And I would recommend you learn all these phrases, all the terminology, and get out there, join some investor groups, be active in the meetings, network with these investors, let them see how knowledgeable you are, so that hopefully once they feel comfortable with you, they will start referring you deals. And it's like a tidal wave. Once you get one and you delight them with your service and exceed their expectations, they're going to give you more deals from them, as well as refer you deals from their investor buddies that they run around with. So definitely look to the mortgage calculator for all of your fixed flip loans, DSCR loans, and all other type of loan types.
All right, let me go ahead and see if there are any questions here in the chat. So I do just want to point out I do just want to point out here that let me take that off the screen. Sorry about that. So amazing programs right here, and the BRRRR method is an amazing way to build a real estate portfolio. So it's definitely something. Again, that's why it's a hot topic, right? As Jose was saying, your borrower can take the same $100,000 they have to invest, right? There's no way they're going to buy 10, 20 properties, but through the BRRRR method, they can buy one, rehab it, rent it to stabilize it, refinance it to get the money back plus then some, and then repeat the process, right? So you can do one at a time, use the same $100,000 down payment 10, 20 times in a row using the BRRRR method. So instead of just buying one property or, you know, you know, like I said, not being able to buy multiples, you can build an entire rental portfolio, a little I guess portfolio, right? Is the word I'm looking for. A nice little rental portfolio, little empire there, just using that same capital for the down payment. So that's why it's such a popular um, concept right now, and especially since rents are so high, like Jose was saying, it's just an absolute. Usually, you're going to knock it out of the park, right? And when you do, then it's easy to come and do it again and again and again. And as the loan officer, not only are you a consultant with them through that first deal, but also, as Jose said, there's the refinance on the back end, right? The second deal, and then there's the repeat, right? So, as loan officers out there, make sure you're familiar with these things, make sure you're educating your borrowers on these things, and make sure that you're equipped to handle these type of loans when they come in, because it's not just one loan, it's at least two. And then who knows where it can take you from there. You might have a client that does 10, 20, 30, 40 of these loans with you.
Absolutely amazing. And like I also mentioned, credit score preservation, right? It's not the first flipper that I run into that's now trying to cash out a property and now their credit score is 560. And when I ask them what happened, did you miss payment? He says, no, I didn't miss payment, but my credit cards are all jacked up to the max. They're over the limit. What are you going to do then? At that point, they're relegated to selling the asset because they can't get any viable financing to make it worthwhile. All they would really be able to do is refinance maybe what they owe at a really high rate, if at all, with no monies from the transaction to be able to do the repeat part, right? It doesn't work unless you can do the repeat part. At that point, you're just a flipper selling properties and you're not benefiting from also being an investor.
Right. And I do want to be clear too that remember your clients can also, investors can do this without the fix and flip loan, right? It doesn't actually, Jose saying that's the way to do it to not run up your credit cards. But just to be clear, especially the beginners out there, they don't have to do a fix and flip loan for this method, right? This, excuse me, this method is not a loan, right? A BRRRR is a method. So whether you buy the house cash and put cash into it, and you know what I mean, and then refinance out of it to get your cash back, or whether you buy it with a regular loan and then put cash into it to fix it. That's possible too. You could also buy it with a regular loan and put your credit cards into it to fix it. But as Jose said, you're going to be a lot better off doing a fix and flip loan at that point and paying whatever the fix and flip cost is as opposed to 25% on your credit cards or whatever it is and ruining your credit score.
Yeah, because on average, somebody with good credit is going to be able, and if it's a profitable flip, even with limited experience, is going to be able to finance anywhere from 80 to 85% of the purchase price of the asset for the initial distribution at closing, for the closing, right? Which means they'll give 15 to 20% down payment of that low purchase price and get 100% of the renovation financed. And that's the key.
That's actually the answer to that first question there. So I went ahead and brought that up.
Yes, I mean it does need. You're always going to need a down payment for the flip loan. The minimum down payment for a super duper experienced flipper with great credit and a very profitable flip is 10% down of the purchase price, which is 90% loan to cost and 100% of the renovations.
Next question here is what current rate and does it mean FICO score?
Well, again, the current rate is all over the place, right? There isn't one flip outlet, right? So we're gonna look always for the lowest cost and lowest rate option, but sometimes we need to go to a conduit that does that allows low experience flippers with a high loan to cost, or maybe a lower credit score flipper, or a no credit score flipper with a profitable flip, right? So again, it's all over the spectrum regarding FICO score requirements. But if I were to try to generalize in the majority of the cases, they're going to be looking at minimum. Now, this is not all the cases. I'm saying in most of the cases, but remember, we have low FICO score options and we have no FICO score option. But if you want to go with a rule of thumb, 620 or above for an experienced flipper and 660 or above for a flipper with zero experience. And the rates could be anywhere from probably from the high nines to low tens up to 13, 14, 15% if it's a zero experience flipper with no FICO score and a flip that's not too profitable. So it's each deal is specific.
Whoops. There we go. Okay, next question here. And then it looks like we got one more and then we'll wrap it up. How long is the closing time also going to depend on
Okay.
closing?
We have fixed flip options that don't do an appraisal physically of the property. They do a desktop appraisal. Obviously, those are going to be quicker, and those we can close in 7 to 10 days max. We can close that option, and but typically the flip loan could take 18 to 21 days at least to close. And remember, as all other deals, when an appraisal is involved, if the appraiser sets you back, that's going to delay your closing. And also, if the title company has a delay due to the title search taking longer than expected or the lien search or whatever, that's going to delay your closing. So keep in mind that it's not always about this how quickly can the underwriter review it and how quickly can the loan officer put the file together and submit to underwriting, but it's also the other services of the loan like the appraisal and the title work that is also going to contribute to the turnaround time to close.
All right, last question here. So, can I use this for renovating a self storage facility?
Well, again, this is renovation for the purpose usually of bettering the property, adding value to the property. If the renovation is not adding value, they may not lend on it, right? That's why as is value, purchase price, um, renovation costs, and after repaired values are key components to knowing if a loan will be able to be made on that asset. Now, self storage facilities, that's a commercial asset, limited offerings, but there are fixed flip loans for commercial properties.
All right, and another question just came in here. If I buy a flip, can I do my own loan? You can't do your own loan, but a teammate can do it, and you would get a lender credit, right? So, kind of in a roundabout way, but you wouldn't actually be doing your own loan. All right. I don't see any other questions, so we'll go ahead and wrap it up. A great topic here today. I recommend people, you can go do a lot of research. We actually have a couple other presentations on BRRRR if you type in BRRRR, the mortgage calculator or whatever. But also, there's tons of podcasts and videos and trainings and all kinds of stuff on the BRRRR concept. And again, it's a hot button topic with your clients and with investors, right? And so it's something that you should be aware of, be talking to them about, and it's something that people are really interested. It's something that especially a lot of the younger generation are aspiring to do to build wealth. So it's something that you need to be very aware of, know how it works, and be able to do it so you can help your clients out with that. So with that being said, thank you everybody for tuning in, and we will be back here tomorrow with a new topic. So we'll see you all tomorrow at 7 p.m. Eastern for the next episode of the Loan Officer Training